Hey friends, I'm back. I want to share with all of you 6 stocks that I own in my personal dividend stock portfolio. All 6 of them are in the news right now, and I would say 3 of them are winners and 3 of them are losers right now. And I put winners and losers in quotations. You'll see why. I have a few bonus stocks I want to share with all of you today as well. I'm going to tell you, as a dividend investor of multiple decades, these days there is more news than I can remember. And so I want to break it down for all of you in the video today. First, a friendly reminder from our friend Warren Buffett. Check it out on the screen right now. So Warren Buffett has a famous quote, and that quote goes like this: "Only when the tide goes out do you discover who's been swimming naked." This is a reminder to all of us, to myself, to everyone watching, that I am just sharing my personal journey here for fun and entertainment, and that there are some certain background pieces of information you probably want to take into account for your own strategy, and that I certainly take into account for my own strategy. Emergency fund. I like to have emergency fund of greater than 1 year. Diversification. I am broadly diversified across 42 stocks and ETFs, and not any one stock, even my largest position, is going to affect me too much. I'm talking about individual stocks today, but please keep that in mind. Long-term approach. Anything less than 10 years is short run to me. And so I'm talking about winners and losers, but those are in quotations because this is really short-term news. We're talking about Q3 earnings reports. Last, I'm a dividend investor. I don't lose money until I sell, and I generally buy to hold forever, and I invest for the dividend. When I really lose is if a dividend gets cut or suspended, because I'm investing for cash flow that I can use to pay my bills. And so just a friendly reminder from Warren Buffett that there's a lot of just basics of portfolio management that we always want to take into account as investors to protect ourselves in volatile times. And certainly we are in volatile markets, and you're going to see some of that today. I'm going to start with a winner to make myself feel good. This is Caterpillar. This is a stock that I'll just share right away. The big lesson for me is I don't like to cut my winners. I like to just keep them and let them continue to new heights, because Caterpillar keeps surprising me to the upside. Check it out. So they had their earnings, and their Q3 earnings were fabulous. Revenues were up 10% year over year in Q3. Adjusted EPS beat the analyst estimates of 452. They came in at 495. But here's where I put winner in quotations. Last year, the adjusted EPS was 506, so it's down. Operating margin is down. It was 17.3% versus 19.5%. And so the stock was rallying, and sometimes I just can't figure out why something is a winner or a loser, because when I look at those numbers, I look at them as a mixed situation. Maybe the fact that it is such a winner and it went up so much is just that it beat this arbitrary number that the analysts had. But is that really winning because the EPS adjusted was down from last year? I don't know. I think why they probably are winning is they are going to be kind of the construction equipment company of the future, using a lot of AI. And a lot of companies now, if they are working with AI or they're working with technology, those are the ones the market is rewarding. Anyway, the market thinks it's a winner. I love the company. I've been in it a long time. Check it out. A few more thoughts. So I've been in this company since 2013 at $86. It's now at $577. My unrealized capital appreciation on the first tranche is 570%. My first tranche simple yield on cost is now 7%. I love to see it at 10%. It's going to get there, I think. My big thoughts on this: I'd like to let my winners run. Caterpillar has surprised me time and time again. I keep thinking, should I sell it, redeploy the money elsewhere? I never do. I'm glad I haven't, because it keeps hitting new heights. It just surpassed 500 recently, and I was celebrating. Now it's at 577. It's now almost 2.5% of my portfolio. And I kind of think, is it a technology investment? I think it kind of is for the industry in which they're in. And I think that's why Wall Street honestly is celebrating the company and the fact that the revenue is up. And I'm sure the earnings over long periods of time will probably continue to follow. And so that is a clear winner in the news over the last week. But am I buying Caterpillar here personally for my very personal situation? I don't share investment advice, just my personal situation for fun and entertainment. I'm not adding here because I think the market, going back to Warren Buffett, it's a voting machine and it's moody. I think it got a little moody and almost overconfident on Caterpillar here. So I'm not buying more, but I'm going to let it be, see how it does. I love the stock. I'm a proud shareholder. I want to go on now because the second stock is a brand new stock to my portfolio. A lot of you guessed it in the comments of my last video, which I'll link to in the pinned comment below. It is Meta. I now am a shareholder in Meta, believe it or not. I bought the stock as a long-term yield on cost investment because I invest for dividends. I'm not in it for capital appreciation, although I would like to see some. That would be really nice. But I bought it for the dividend and the growing dividend. Let's talk about Meta because the stock market thinks it's a loser now. I actually think it's a winner, but I put it as a loser in quotations because the stock went down on the news. Check it out. They announced Q3 earnings and their earnings were, I thought, good. Market didn't like it. Revenues were up 26% year over year. I loved that. They had a one-time non-cash tax charge related to the big beautiful bill of $15.93 billion. The market seemed to hate it. If you're an accountant or a tax professional, put in the comments below what you think. I don't know what I'm missing here, but it's non-cash. I don't know why it's such a big deal. CapEx is expected to come in 70 to 72 billion this year versus a prior range of 66 to 72. Wall Street hated this. I like it because they're investing for the future. They're investing for AI. But Wall Street kind of thinks, hey, maybe they're doing too much CapEx here. Are they really going to get a return on that investment? Only time will tell. The reason I invest in AI via Meta is a hedge. My portfolio is very, very small in terms of its allocation to technology. I think if I remember correctly, I did a post on my Patreon about this last night. I'll link to my Patreon below, to my Backyard Corner Patreon. I think I'm about 2% in technology or so, pure play technology. Obviously, I have related ancillary plays like Caterpillar, which is probably a technology company too, but pure play tech companies, it's very low. I added Meta for the exposure to AI. I love their CapEx. I think it's great. I want to have that hedge in my portfolio, and I also think it could be a great dividend growth stock of the future. Let's keep going. So some thoughts and some background I have on this stock. As you can see, I started buying recently. I share my trades over there on Patreon, Backyard and Corner Patreon. Check it out in the pinned comment below. I bought all the way from $7.49 this is just my last week's worth of buys. I bought it 3 times this last week. $7.49 before earnings, then $6.68 after it tanked, then $6.47 after it tanked more. My position's now fully built. I'll be reporting on this, by the way, in more detail in a separate video. I'll do a whole video about it, but I got to go quick today because I have 6 stocks to cover. Thoughts? Is it a great dividend growth stock of the future? Sometimes in dividend growth investing, we don't have a lot of new innovations. I actually think this is a new innovation. We have access now to stocks like Meta that are paying a dividend and are growing the dividends. I don't expect meaningful dividend income from this within the next 10 years. It'll probably be 20 or more years. We'll see. I'm late to the game. I think this is the most important thought on Meta. I could have bought this sooner, but if I bought it sooner, there would be no dividend. And back in those days also, it wasn't earning a lot of money like it is now. I'm a more conservative investor, and so sometimes I miss the companies in the early days, but I also protect myself against companies that don't make it to where Meta is. For every Meta, there's a lot of companies that didn't make it. And so I bought Meta recently because it is earning a lot of money. I believe the PE adjusted for growth is low. And I believe now after earnings, after it dropped a bit, it's on sale, not deep discount, but on sale. And I love the dividend that is growing. And so that's a loser, but it's new to my portfolio. And I look at it as a long-term winner for my personal situation. Okay, I got to keep going. Stock 3, as you can see on the screen. Let's go back to winners. Okay, this one is a winner. It is ABBVIE. Everyone knows about it. I've talked about this for so many years here. But Wall Street, honestly, they kind of dislike the numbers a little bit, but I'm calling it a winner. You'll see why. Let's just talk about it. The dividend, it was increased by 5.5%. I'm now yielding over 10% on cost, simple on my first tranche. I highlight it. It's a winner in my book. But why else is it a winner? Revenues were up 9% year over year. The earnings were down, but I think this is where Wall Street, Mr. Market got moody a bit, is the reason the earnings are down is due to an acquired IP R&D and milestone expense. I don't want to spend too much time on it, but the way things work with ABBVIE, I've talked about this in old school videos, is when they acquire a drug and it's under development, sometimes it has milestones in the future, like they hit a certain number of sales or it makes it through phase 3 or different milestones. They're able to bring it to market, and with those milestones come expenses. It seems like an expense was triggered in Q3 that affected their earnings, but usually these things are good because it indicates they're making good progress. The other reason I'm calling it a huge winner here, a huge winner, is back in the day when I bought this thing, it was in the days where everyone was worried about Humira, what would come next. Their blockbuster drug was going off patent protection. We'll check it out on the screen in front of you right now. You got to see this. Skyrizi and Rinvoq came and they really saved the day in a big way. Global Skyrizi net revenues were 4.7 billion, an increase of 46.8%. Rinvoq, 2.18 billion, increase of 35%. Humira, 993 million, decrease of 55%. So Skyrizi and Rinvoq, they came in, they saved the day. I took a calculated risk on this stock back in the day. And my calculated risk that I took, it paid off. I like to buy the best companies in the world when they're facing some kind of turmoil that I think they can make it through. And that's how I buy on deep discount. I bought pre-Allergan merger with ABBVIE. And as you can see on the screen in front of you right now, what happened is I now have obtained a 10% simple yield on cost, which is why I invest. Literally what I highlighted here, I don't invest for the capital appreciation. I'm up 224% on my first tranche, but I don't invest for that. I share the capital appreciation, and you'll see later some capital depreciation in the video today because that's what everyone looks at. But ultimately, the only reason I invest is for dividend cash flow to pay my bills. I can't do much with stock prices because I don't sell. And I don't want to have to rely on stock prices to pay bills because they're too volatile. Thoughts, long-term yield on cost, Warren Buffett, be fearful when others are greedy, greedy when others are fearful. I was greedy on this when others were really fearful, ended up being a winner. Not all of them are so good, but ABBV was one of those. Look, I share my journey here. I'm just like all of you. I have a well-diversified portfolio, and in any well-diversified portfolio, you're going to have stocks like Caterpillar or ABBV that do exceptionally well, and others which kind of do okay, and others that don't do so well. I'm going to talk about a stock next that's a loser, and it's not done bad, but it's been kind of okay because these days I'm only up a little bit. I haven't made a lot of capital appreciation on this, and honestly, the yield on cost isn't going as quickly as I wanted either because their last dividend increase was really low. I think it was like 1 penny. But let's talk about, as you can see on the screen in front of you right now, Starbucks. Starbucks on the news, I'm calling it a loser, but it was kind of flat to slightly up on the news. And I think the reason it was up actually is because the same-store sales increased 1%, which was a new milestone under Brian Niccol's management. Revenues were up 5%, so top line is good. But you can see I'm calling it a loser here in quotations because GAAP EPS is bad. GAAP EPS is 12 cents. Non-GAAP was 52 cents. Both non-GAAP and GAAP are down. Non-GAAP declined 45% year over year or 34% on a constant currency basis. Look, Starbucks has a problem right now with the bottom line, with earning money, and they need to earn money to pay my dividend. Top line revenue, people are still going to the stores, they're drinking coffee, same store sales are up, all of that is good, but they need to figure out how to drive more profit on the bottom line. And I have a few thoughts. Check it out. Let's go through it a little bit. So my experience with the stock, it's my number 3 largest position at 6.78% of the portfolio. I built a big position in more recent years. I'm not up much anymore. I'm up just a bit. So it's kind of flat. It's not my best performer. I bought due to prior rapid dividend growth, which has now slowed. I'm going to talk more about that. And I do still believe in the business. I'm willing to wait it out. So pre-pandemic, which is really when I started establishing my position in Starbucks, it was a different world than post-pandemic. Pre-pandemic, I would say inflation was under control. Post-pandemic is a world where inflation, especially on these types of things like food, is not under control. I'm encouraged by the top line. I do not see a quick path forward on the bottom line. In fact, I don't know how they're going to fix the bottom line. I'm relying on Brian Niccol to do that. And I think it's going to be hard because even Chipotle, which is a company that Brian Niccol used to run, tanked this last week, but he's no longer there to lead it. I think it could be slow for a number of years. I'm willing to wait a long time. This is where I go back to Warren Buffett. I diversify even at 6.78% of my portfolio. If something terrible happens to this company, I'll be fine because of diversification. And that's why I always look at investing in a more conservative and diversified approach. Also, though, I'm patient. I'm willing to wait it out. I love the company. I see promise in the long run. But this could be a period here, another 5-10 years, honestly, to see them turn around the bottom line. I don't think it's going to be quick because what happened is our world changed. Post-pandemic, the input costs, coffee is more expensive for them to produce and just the raw source of coffee. It's more expensive. Labor is more expensive, so they're figuring out solutions for their partners and how to compensate their partners. That's more expensive. Their margins are getting squeezed. Post-pandemic is a different world. Why are the tech stocks doing so well? Well, Meta, it's kind of the outlier, but other tech stocks I own, like Alphabet, doing really well because the marginal cost of scaling, it's not the same as the marginal cost of producing more food items or coffee items. Each additional coffee or food costs good money to produce. To scale, though, the cloud, like the Google Cloud, for example, they put in the investment up front, but then they can scale this thing almost infinitely. Scaling software and technology, it's a lot easier. Also, our world is just transforming. But those are some of the trends that are happening right now, and that's why I classify Starbucks right now, even though I love it, and it's the number 3 largest position in my portfolio, it's kind of a loser right now, and I got to be real with myself about where it stands. I don't expect the dividend to grow very quickly in the short run either. The last increase was really low. Okay, that was painful. After all that, let's go on to another winner in the portfolio. Check it out on the screen right now. Let's do this. And so the next stock that I want to share is OTIS. I don't talk about this one as much. So OTIS is an elevator company. And funny enough, not all winners are tech stocks or kind of related stocks like Caterpillar. People are probably calling that a tech stock now. But OTIS, it's an elevator company, old school. But the net sales are up 4%, 2% organic basis. GAAP EPS was down, but adjusted was up 9%. And this is a real adjustment because adjusting for non-recurring tax benefit. Organic service sales were up, so service revenue is good. They increased their EPS outlook. Good stuff. My experience with OTIS, it's actually, if you add up RTX, OTIS, and Carrier, it's my number 3 largest stock. It's actually larger in the portfolio than Starbucks, believe it or not. So let me go back. Let me rewind. In the early days of my channel, I talked about United Technologies, UTX. What happened is they spun off OTIS and Carrier, and then they merged with Raytheon to become Raytheon Technologies. I said at the time I'm going to manage all 3 stocks as one. I kind of am. And if I add up all 3, it's my number 3 largest position. It's been one of the solid performers, maybe the best performers in my portfolio. These are awesome industrial companies, and they've done very well. And it's proof that not always does it have to be a tech stock to perform really well these days. Even these older world companies can perform well. But let's keep going. As you can see on the screen, some more thoughts. So what I want to talk about with OTIS is I've owned it since the UTX days, and this is an example of a spinoff done well. I have examples where spinoffs have not gone well. I own a stock, Realty Income. They spun off a REIT called Orion, ticker ONL. Unfortunately, I held on to that one, and then I ended up selling it. It didn't perform well. Not all spinoffs do well, but this spinoff, OTIS, did well, and so did Carrier. So proof, spinoffs can do well. They can be done right. Some more thoughts. It's an unexpected winner in the portfolio. Portfolio management is a game of diversification, and then it involves skill, lots and lots of patience, and a bit of luck. I would say people are asking me about Honeywell, another stock I own. They spun off Solstice this last week. This is why I'm saying, guys, there's more news in the market than I can even remember. I'm going to hold Solstice to see if they pay a dividend. And if they do, I'm going to monitor it. I'm going to analyze it. I'm going to learn more about it. I'm hoping that Solstice and Honeywell, that situation, it's going to be kind of similar to what happened at UTX. Honeywell actually is planning yet another spinoff, I think, later this year or next year. So we'll hope that Honeywell is kind of like UTX, and it's not like Realty Income. But now for my number 6 stock, I got to get into a loser, but I put loser in quotations because I'm not sure if Wall Street got this right or wrong. And this is a small cap. And I want to say ahead of time, with small caps, they're always more volatile. And I limit my exposure by keeping them very small in the portfolio so that if the small cap has some really bad news, it doesn't affect my portfolio really at all. But anyway, let's look at it. UTS, check it out. UTS is a stock I own in the salty snack food space. It's very small. These days, it's only 0.28% of my portfolio. It's a fun, small position, but I love their product, and I see them as a potential growth stock, dividend growth stock over time that can produce more cash flow, dividend income for me. Q3, let's see why Wall Street hates it, and it tanked 20% in a single day. Sales increased 3.4%, but the net income decreased to minus 20.2 million. Adjusted net income increased 13%. This is where things are weird. So they're losing money net income, but then adjusted, they're making it, and it's up a lot. EPS on an adjusted basis is up 9.5%, but unadjusted, just diluted, it's minus 17 cents a share. They're making an expansion into California. So the thing I would say first and foremost about UTS is the numbers are just wacky. And so I need to take a deep dive into the numbers and understand them more. I'm trying to figure out, is this a case where Mr. Market is right and they see something I don't, and these adjusted numbers are not worth looking at, and the gap numbers are what we have to look at, and hey, it should be down 20% in one day? Or on the other hand, is Wall Street just not taking the time to really figure this out and Mr. Market is wrong? And so I got to figure that out. But as you can see on the screen, these are just some numbers I pulled. And what was really weird, and what I would love, if you're an accountant or an expert at looking at financial statements, please put what you think in the comments below. I got this from their earnings, and you can see they're seeing depreciation and amortization and also non-cash adjustments in both gross profit and in SG&A, sales, general, and administrative. I'm not used to seeing that kind of accounting that they're doing. And so I'd like to know what you think. But when they make these adjustments, well, UTS could be a hidden gem here. And so especially with it going down so much. And so if you are an accountant and you just saw what I put on the screen, put in the comments below. It would really help me out because I'm trying to get to the bottom of this. But I have more thoughts. As you can see on the screen in front of you right now, next thing that I want to share is just my experience with the stock. Hey, I'm down 52% unrealized, but it's small. So I don't really see it on my portfolio aggregate level because it's really small. And put another way, if you own the S&P 500, you've got stocks like this in there that are up, way down. You just don't see it day to day. But because I'm kind of constructed my own ETF, I own 42 different stocks and 2 ETFs in there as well. I see them all. And so I get to see all of the fun stuff that's happening in the portfolio. But dividend yield is 2.3%. I'm wondering if I should add a little more here for fun. Nothing too much, but a little bit. Thoughts, higher risk investment. This is new to the public markets. It's a small company. I look at it like a startup. Post-pandemic, kind of like Starbucks, CPG food, it's more difficult to scale. Small companies have it more difficult. A marginal cost of tech and apps is nominal. Marginal cost of producing food is very high. Is Wall Street missing something here? I need to do some more deep analysis. And so that's my thought on UTS. And so far, 3 kind of winners, 3 losers. Are they really winners or losers, though? I put all that in quotations. And oftentimes, the ones I just labeled as winners, I'm not buying more because they're kind of expensive. But the ones where I labeled as losers, like Meta, for example, will I buy even more? Maybe. Will I add a little UTS? Maybe. Will I add more Starbucks? Probably not, just because I already have so much of it. It's a big position in the portfolio. But that's kind of what's fun about dividend investing. Sometimes I seek out the losers that I think can turn things around in the long run. Put in the comments below, though, what you think about these winners or losers as well. But I have a few bonus stocks. As you can see on the screen in front of you right now, I'll go real quick here, but I have 3 more winners and 1 loser. And again, in quotations. So the winners are ABBVIE. Had huge earnings. I shared it in the video last week. I'll link to that in the pinned comment below. Kimberly-Clark is a winner. It was up on the day when all the market indices were down. They had reasonably solid earnings. Sleep well at night stock, not really growing super quickly and not going to make anyone any kind of fortune overnight, but it plays a role in the portfolio. Honeywell and Solstice, I kind of call them a winner because they did the Solstice spinoff. That's kind of cool. Let's see how it goes. Loser this last week was Altria. It was down a lot, about 7.8% in a single day. I did a short about it on YouTube. I'll link to that in the pinned comment below. Hope you watch it. But I still think Altria is a winner because their EPS was strong, and I'm still up a lot because I bought it on value. And so those are a few thoughts for all of you. So much news. It has been a lot to keep up with it. By the way, I'm sharing all this news in real time over on Blossom Social. I'll link to that in the pinned comment below if you want to sign up. It's free to get started. That is my affiliate link. And I'm long Blossom and I'm compensated for signups, but it's free to get started over there on Blossom. I'd love to see you. I have like 47,000 followers there now. Blossom Social now has 500,000 investors on the app. And it's an app where we're talking about investing. It's a lot of fun. In terms of a full disclosure, I'm long these stocks mentioned today. This is going to be a lot, everyone. So I'm long Caterpillar, ticker CAT, Meta, ticker META. I'm long ABBVIE, ABBV, Starbucks, SBUX. I'm long OTIS, OTIS, Carrier, CARR, RTX, RTX. I am also long UTS, ticker UTZ, Google, or Alphabet, GOOGL. I'm long Kimberly-Clark, KMB, Honeywell, HON, Solstice, SOLS. I'm long Altria, MO, And I'm long Realty Income, ticker O. I'm also long Blossom Social. In terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. Please consult your licensed financial advisor before making any financial decisions. Again, I'm just sharing my journey for fun and entertainment. I have all of my disclaimers, as always, in the description below. I love you all. I appreciate you. Thank you for watching my video today, and I'll see you in the comments below, and I'll see you in the next dividend stock investing video.